Kia ora. Now I'm going to go through an exercise on group accounts. Okay, so you've got this to do as an assignment, and you'll also have it in the exam. Okay, I've sort of tidied up the format of the question, so this is probably a little bit tidier or a little bit more straightforward than you got in the assignment. But this will be how it will be on the in the exam. But you'll be able to match this up with your assignment anyway. The questions I've just sort of put the information in slightly different order so that there's probably more of a process to follow. And I've also added a process out the side here. Okay. Okay, and we'll go through that. So I'll leave the process here. That'll be on the template in the exam as well, right? But it also sort of follows the way I've provided the information. Okay. There's an 8 over here which you don't need to do, right? It's just so that you're aware that typically after you do that, because you're adjusting the profit for the group, you'd also consider what sort of deferred tax or whatever thing, but don't worry about that for now. That's not in this paper, okay? But I've just put that there just because that's sort of about the final step of the process normally. Okay, so typically, okay, so we've got an acquisition of a business. So this is a set of group accounts. The concept behind that is you report as if the two companies were one entity. Okay, so if we're showing them as one entity, obviously that the group account shouldn't show the investment in one of them. So that's the first thing that we need to do, is eliminate the investment. And this tells us about the investment. The investment will show in the accounts as I spent 1.12 million on that investment. So if we would go down to the financial accounts for Big Limited, down in the balance sheet, there should be an investment down there, shares in Small Limited, there it is, okay? So we need to get rid of that, but we'll see how that comes through afterwards, right? I've got all of these figures showing here already. Anyway, I'll leave them there for now. They really shouldn't be. I've put formulas through there already. That's all I've done there really. So we don't need to worry about it too much. Okay. I'll get back to that. Okay. Okay, so we need to, that's the first thing we do, we need to acknowledge that we've got to get rid of the investment. The way we get rid of that investment is by looking at what we actually acquired. So when they acquired Small Limited, this was the balance sheet of Small Limited, right? So not a problem. We bring in the liabilities and the assets and all that sort of stuff into the balance sheet. That's fine, but what we don't recognise is their share capital, and we don't recognise their retained earnings, and we don't recognise their other reserves. Okay, all right. So that's that. Just to make it a little bit more tricky, also that the property that we acquired from them was revalued upwards by 20,000. So we need to also acknowledge that. So we eliminate the investment in the subsidiary, include any asset revaluations. Okay, all right. So let's have a look at how we bring that journal in, that first journal in. Okay, so we've got to get rid of that share capital. Okay, so that share capital has got a credit balance of 875. Okay, because if you look at those transactions, that 875 will be down in the balance sheet, in the statement of equity for here it is. There it is at 875. So that's issued shares, right? So okay, but those issued shares are held by the parent. So we need to eliminate them. Okay, so the entries will be, okay, so what we do is issued share capital will be debited 875, okay, 875, 1, 2, 3, okay. Now because I've already got the equals over here for that because I've done this earlier on. That's automatically posting, okay? But for you, you would have to put equals in that cell, that, okay? Which I have got already in there, okay? We won't get too far ahead of ourselves. What you do is you do all the journals first and then you would post them.
It's 12 o'clock.
Okay? I just don't want this tutorial to go on too long, so I've pre-done some stuff. Okay, so you can see that we have to debit that. The retained earnings, we debit 150, 150, 123, okay, and that will post over there as well. Okay, there's 150 that's posting to where it should post. Okay, then there's other reserves. Okay, and that's 160. Was that 160? No, it's just 60. 60, 1, 2, 3. Okay, that's perfect. Okay, right, at this point, that's what we've got to bring in, but we might as well bring in that other $20,000 too, which is an increase in the what those assets there were considered. So we brought them in at 820, right? What they're saying now is they're worth 840. Okay, so we need to, but that's only a reserve, asset revaluation reserve. We're saying those assets are $20,000 more, so we create the reserve. Okay, right. Okay, the investment in small limited we know is 11220. 1 point, so it's 1120123. Okay, that's fine. But these journals have to balance. Okay, so what we can see is that let's have a look at that. That adds up to that. Okay, so it's short an amount. It's short $15,000. Okay, so we need to balance it. So that would have to be the same. So now that it balances, we know that's the same. And that balancing thing is the extra we paid when we purchased those shares, right? So we purchased the shares, we got the retained earnings and the other reserves, because all those retained earnings and other reserves and share capital, in reality what we're bringing in here is the equity, getting rid of the equity, because that equity would be made up from the assets and liabilities that we brought in, right? So the premium we've paid will be called goodwill on acquisition. Okay, so that's bringing in the acquisition, right? Eliminate the investment in the subsidiary, include any asset revaluation. So we've done 1A and 1B. Okay, I've put a reference here. Okay, you don't need to do this in the exam, but I've put this here just so that when you're looking at my answer, you can actually see where I've got the information. Obviously, you can also track, right? The template I give you, I will leave this total at the bottom to check the balance, because all journals must balance, right? So as we post these journals, right, okay, I've already put the formula in there. You'll have to put the equals that, okay, equals that, right? You need to post them, right? Okay, but I've already got it set up for me to do, for it to do it for me, right? So in the old days, you used to have a posted stamp whenever you posted something, right? So whatever you want to do to mark that you've actually completed that, right? So I know I've posted that, right? So that's all well and good. So I can go into the second element now. Realised profit in current year for opening intercompany inventory holding. Right, so we would have done an adjustment at the end of last period, right? Okay, but that's fine. Every time you do a group set of accounts, right, you're taking the two separate accounts and you're adding them back together, okay? So at the beginning of the year, Big Limited held inventory purchase from Small of 89,000. So it had 89,000. Small Limited held inventory purchase from that'll be from Big Limited, not itself, okay? Limited of $57,000, okay? So it's purchased it, but the other company, which is in the group, has acknowledged that they've made a profit on that, right? We don't want to acknowledge any intercompany profits, right? And okay, until they're realised, okay. So what we're saying there is, at the beginning of the period, Big was holding inventory of $89,000, which Small Limited had banked as sales with a margin on it, and vice versa. Small had some inventory that had bought off Big Limited, and Big Limited had acknowledged some profit on it. So we're showing profit generated just within the group, which is not correct, right? We don't want to. Otherwise, you could just have transactions going backwards and forwards between your two companies, and yeah, it's sort of so, and you'd have your overvalued stock basically. So what we're saying is that the stock is overvalued within the group. Okay, so how do we make an adjustment for that, right? So it was at the beginning of the period, okay? So we need to do a journal entry, and what we're saying is really the cost of goods sold, what we've recognised as cost of goods sold, is too high, okay? So this is to realise profit of opening inventory in the current year, because that opening inventory would have sold by now, right? Okay, so the calculation here is there's a markup of 20 there's a markup of 20% and a markup of 30%, right? So whatever was the opening amount for on that 89, there's a markup of 20%, okay? So that's the profit figure there, okay? We've got to add those two figures together, okay? So those two figures together is 27, 28, 2805, isn't it? 28050. Oops. I think that's where I put my notes actually. Yeah. 28050. Hopefully my maths is working. There must be another 2 in there. No, that's right. Okay. 28050. Okay. So what we're actually doing is we're actually recognizing. In the accounts for in the accounts, the separate accounts, we've recognized a profit last year of that amount, whereas in reality we need to recognize it this year, because that's presuming that stock is now sold. Okay, so that can be recognized this year. Okay, so in the separate accounts, it would be showing as retained earnings from the previous year. Now that we're consolidating the accounts, we've got to acknowledge that that shouldn't be there for last year, and that here it is. That'll improve profit for the group set of accounts this year. Okay, and there you can see that it's posted over there. Okay. Third thing we've got to do is we've got to acknowledge the stock we've got on hand at the end. Okay, so the stock we've got on hand at the end is showing inflated in both balance sheets, because it's got the markup on top of it, all right, because it's gone between the two companies, right? So we've got to get rid of that, right? So we've just got to work out what that markup has been, okay? And we've got to acknowledge that we've overstated our sales, because our sales hasn't gone external. That stock's still sitting in the group's warehouse. So whatever those two figures add up together, which will be 27,500, 27,500, we need to reduce our sales, and we need to reduce what stock we've got sitting in the warehouse, because we've only inflated it from selling it from one company to the other with a markup. Okay, so we've got to get rid of that. So we've done 1, 2, 3 of the jobs, right? Okay, and that's automatically posting over here for me. Okay, you would have to post those to the appropriate accounts. Okay, if I go down and just check it's still balancing, yep. So my journals are working. They are working, which is good. Okay, right. Fourth thing. What's the fourth thing say to do? eliminate intercompany sales. Consider any depreciation adjustments due to intercompany sales. Okay, that's only if one company sells another company a fixed asset, or it sells something it buys and sells, e.g. one of the companies buys and sells trucks, the other company can use a truck. So company A is recognizing the sale of the truck, company B is buying a fixed asset. Okay, there's still a margin or a profit on that, right? So there's obviously just the straightforward sales where one is buying and selling things, but there can be that sort of complication. I'm selling you something that is an inventory item for me, but it's actually what you're buying is a plant and equipment, right? So we've got an example of that, and we'll see how that kicks in, right? So we need to, number 4 is let's just look at just typical normal sales. Okay, during the current financial year, Big made sales of 350 to Small, and Small made sales of 250 to Big. So that's a total of 550. Right. Okay. So the intercompany sales, we need to get rid of the intercompany sales of 550. Get how we got that. We've overstated sales because we've sold them to ourselves basically, and really we've acknowledged that we've had cost of goods sold of the same amount, right? So this won't affect your profit at all. Your profit will stay the same, but it'll show a correct level of sales, right? So it won't overstate your sales by $500,000. Okay. Copy, paste. All right. So that would have posted over here, so we can reduce sales. Okay. All right. So that's all well and good. Yeah. So the next thing is B, which says that Small Limited sold property, plant, and equipment as part of its trading operation. So in other words, it wasn't its fixed assets. It actually had that as inventory, an inventory item. It buys and sells whatever that might be, right? Let's call it a machine. Okay, to Big for 400,000. The item had originally cost Small Limited 320. So he bought the machine for 320, planning to sell it, and he sold it now at market rate of 400, but it's to its parent company, and it's made an $80,000 margin on it. So we don't want to, count that profit because it's an intercompany thing. So how do we do that? All right. So what we've got to do is we've got to reduce the sales down for the group, because that sale was recorded as a sale for Small Limited, and it was 400 grand. All right. So we don't want to record that 400 grand. Okay. Basically, it didn't. What did Small Limited pay for it? Small Limited paid 320 grand for it, right? So that's how much it did. Okay. So where's that extra 80 grand? That extra 80 grand is recognised as an inflated value for the plant and equipment for the group. Okay, because Small Limited only paid 320 for it, but it's sitting in the fixed asset schedule of Big Limited for 400. We want to recognise it at what it actually cost the group. Okay, so that extra 80,000 we need to reduce down the plant and equipment by that amount. Okay, so that will post through. I would have these all linked up to where it should go, and my journals are still balancing. Okay, so there it is. That would reduce down. Okay, so plant and equipment would be that plus that minus that gives us that value. Okay, all right. I've posted that one as well. We're getting there. Post. Okay. Accumulated depreciation. Okay. All right. Okay. Because Big Limited was showing the asset at 400,000 in its fixed schedule, okay, because that's what it paid for it. When it did its depreciation, it depreciated it at 15%. So if we're going to recognise that it's actually only worth 320, we've claimed too much depreciation, right? Because what we claimed $12,000 depreciation on in that 80, okay? So we want to reduce the amount of depreciation we're claiming. So that's reducing the expense, which will be 12,000, and that will be reducing how much we've accumulated for depreciation, right? So that again is only bringing it back to the depreciation on the 320 asset, not a $400,000 asset, right? So that should have gone through to there. There's 12,000. So again, that plus that less a 12 gives you the new balance. Okay, all right. So a lot of these have only got a couple of places. I've made the template where if there's a whole lot of journals that go to one account, like this one here, okay, I've actually set it up so that you've got a number of lines that tee off the merged cells here, right? So for example, I don't think there's going to be any credits to here. No. So for example, I've actually got a formula in there. There it is there. Okay, so that is that plus that. Because sales is credit, you have to minus that, minus that, minus that. And that gives you the new group sales tally, right? So that's getting rid of all of the intercompany sales and showing the group sales to external parties only. All right, okay. Now, did I post that? I think I did. Okay. All right, so that's that. Okay. The fifth thing, to record previous and current impairment of goodwill and acquisition. Okay, you got that in the assignment too. Okay, goodwill on acquisition is considered to be impaired by $10,000 this year. Right, so we've got to write off $10,000 of the goodwill. Goodwill on acquisition was previously impaired by $5,000, right? So previously, in years gone by, we thought it had gone down 5. Now we think it's gone down another 10. Right, so really, because we're consolidating the accounts again, we need to bring in what we'd written off before, which is 5, and we need to write off the extra 10. Okay, so the journal entry for that is okay, we need to claim the expense this year, okay, of the $10,000 that we're writing off, which is an expense, okay, and we'd already previously written off $5,000, so we need to take that off retained earnings again because we'd previously written that off, and therefore the total amount of goodwill that we are amortizing is 15,000. Those two stuck together, right? And that just ironically happens to be what the total amount of goodwill, right? So that first 15 came from that first journal up here, and now we've eventually written it all off. We reckon it's all impaired. Okay, so that's that done. Okay. Okay, so you've got the gist anyway, all right? You just got to make sure that you put these in the right holes over here. Okay, my journals are still balancing. That's good news. Okay, which means my balance sheet should balance. My net assets equals my equity, which is good. All right. Okay, that's the accounting equation. Okay, you know, assets minus liabilities will equal equity. Okay, all right. So your net assets will equal your equity. So it's still balancing. These two balanced. These two balanced. Right. Okay. We've only got 2 more journals to go. To eliminate intercompany accounts, right? So you sometimes, and I've added this up here, review the accounts for intercompany balances. I've added this in here, right? Because really, this information you probably wouldn't just pick up by glancing at the 2 sets of accounts. People would have needed to give you this detail. But these other things you can actually pick up by looking at the accounts, okay? So intercompany accounts is where one company owes the other company money, right? They keep like a balance, right? Just like an IOU, all right? So one of the companies may owe the other company some money. Let's see if we can work that out. Okay, so we go down to, they call them current accounts quite often. Here it is, so it's a current account, right? So in the balance sheet of BIG, it has a current asset of $25,000. So that says that Small Limited owes Big Limited $25,000. All right, it's an IOU. All right. So therefore there should be a corresponding liability in small limited to big limited for 25. Okay, they match, all right? We need to set those off against each other because we're accounting for the group. We don't want to show overstate external. We only want to show external liabilities and assets, right? Or external liabilities and any, yeah. So the journal, to get rid of that, relatively straightforward, is we need to debit one and credit the other. Okay, so since that's what, so basically 25 there, 25 there. Okay, so if we go down and see, that should have got rid of the 2. Right, so there it is. So that was 25, we debit it, it's gone. Okay, and up corresponding up here, asset, credited, it's gone. Okay, right. Wow, last one, number 7. Okay, eliminate any intercompany, intercompany dividends. Okay, all right. So again, you should see these in the accounts, right? So because Big Limited is owns 100% of Small Limited, any dividends paid should have gone to, or would go to, Big Limited, right? Okay, that's straightforward. Don't worry about dividends Big Limited pays, because that's to other people, okay? So it's only the dividends paid by the subsidiary that we need to worry about, right? Okay, so let's see if we can find those. We go down and we look at the accounts, and we can see in the equity thing that there was an interim dividend paid and there was a final dividend paid, all right? So that $50,000 worth of dividends paid, that's coming out of the equity of Small Limited, is showing up as other income in Big Limited, because that's where it would be hiding its dividends, right, and other income. So dividends received of 50,000 will be sitting in there, okay, and therefore we need to reverse this, okay. So what we need to do is we need to say that the dividend income, okay, income's credit, so if we want to get rid of it, we've got to debit it, okay. I don't know why that's, I think, showing up. Maybe I didn't put the notes in. I didn't. Okay, it should be note 7 anyway. Okay, so that'll be, let's reduce dividend income by 50,000. So if I put that there, that should, because I've already put the equals in, okay, it already comes through. You'd have to put the equals in and go there to post it yourself, right? Okay. I don't remember which ones I've posted and which ones I haven't. Okay. And where that comes from is basically that interim dividend in the equity statement, there and there. So I've got to, because those would be debits in the equity statement to reduce equity because you paid out dividends. All right, so that will now bring it down to only what dividend that Big's paid. So we're not acknowledging that, right? Okay, and the other 30,000 is from proposed dividend, right? Okay, maybe put in the right amount of zeros, 3A, 1, 2, 3, okay. So again, now that's got that, and it's only showing the group accounts is only showing the dividend total that comes out of Big, all right? So the total dividends paid out is only what that did. Okay, so we'll acknowledge that, but what's sitting in the balance sheet is a dividend receivable in Bigs, and obviously there's going to be a liability down here, dividends payable in Littles. So we've got to get rid of those two balances too, right? So it's all part and parcel. So we've got to get rid of the dividends payable, okay, Put my notes there so it looks nice. Okay, so we've got to get rid of the dividends payable. So that dividends payable is a liability down here of 30,000. Final do it for 30,000. So to get rid of the liability, we debit it for 30. 1, 2, 3. Okay, shows up down there because I've already got the formula in there, which is just equal that. Okay, and then if we look across, obviously that plus that minus that brings it back to the 70. Okay, and then the dividend payable, which is up here, 30,000, we'll be getting rid of that. 30,000, 1, 2, 3. That posts over to there, and that becomes 0. Okay, so that's all our journals done. Okay, obviously I've done this earlier, so therefore I've got the couple of things going in my favour. I've got the formulas already in it over here. Okay. Okay, but we'll have a look at this. So you obviously can understand how I've posted. So you go through and you'd post that one, you'd post that one, you'd post that one. You just post them. Okay. Do the posting by putting an equal in the cell that it should be, like that is equal to, right, so issued capital was equal to that. That's how I did it, right? The next thing is retained earnings, that one there. Down here, I went equals, and that one. Okay, so that's all I did, right? So that's all I did earlier, right? So equaled all those, and then I did my formulas to cross add, okay, which is that plus that. Because those are both credits, I have to take off the debits to give me that. That's a debit, that's a debit, those are credits. So that plus that minus that minus that minus that gives me that, all right? And that gives me my new gross profit. Gross profit is sales less cost of goods sold, gross profit. Okay, that's interesting. Plus other income, that doesn't seem to be coming across. Okay, so that is that plus that minus that return. Okay, I probably did have it there, I just did have it covered up. Okay, so it was there. Alright, that's pretty good. Gosh, I was going to say, I wonder how it balanced otherwise. Okay, so that's straightforward. There you go. So you can check all the formulas. I'm going to have this up there anyway. Okay, this is a tricky one. This isn't a cross add, right? This one here does not cross add. This one here is you've got to bring down the profit after tax from there to there. Okay, so that is a slight tricky one. Okay, I'll put that in green. I'll put a dollar sign in front of it. That suggests that there's a formula there, right? Some of those zeros. Okay, so that's that. Okay, because obviously getting rid of all these intercompany things, because that plus that does not equal that, right? So we can't just add across here either. Okay, so basically that's the only thing that we don't cross add. That comes down there. Okay, so the group accounts, really, if you were just if you were just thinking, okay, look at that, that's 948,000. Really, 948,000 isn't. To the external world, they only sold 820,000. Okay, there was intercompany sales in there. All right. Okay. Again, total assets, it suggests that if you added those two together, that's 886. 8690 when it's only 740. Okay, so really what are the major swings about here? Okay, got rid of the shares. That's the major major one. All right, the investment, sorry, not the shares, the investment. Okay, so by consolidating it, okay, right, we can see that our journal's balanced. Okay, I'm going to leave it at that for now. Okay, so you've got the worked example to look at. In the exam, you're going to get this template. I'm going to leave that there. The question will be very similar to this. There's going to be no traps or trips. You'll have to put the equals these, equals those, and yeah, you'll have to put the formulas in over here as well to get these things to add up. Okay. I'll leave a blank copy on the Moodle as well so you can practice doing it. Okay, but I'll save this one here as the model answer, and we'll go from there.